Right, so welcome everybody who is here in the room, and if you're following us online as well, this is great to have you, and it's great to have the speakers, as we discussed it during our little prep meeting before, that it's like our annual check and our annual fireside chat with the speakers that we're having every year for the inaugural day of Paris Infra Week, and it's great to see how the situation changed and what happened during this year. Now, to kickstart this, I want to ask both speakers the question regarding the infrastructure investment has fallen short of what is needed to support potential growth. And this gap and this shortfall is especially pronounced in emerging markets. I do want to talk through some of the biggest aspects and issues, but also I would want to hear from you, what are those that you're seeing specifically in your markets? Let's start with you, Simon.
Thanks. Is this working?
It is.
It is working, okay. So look, I think, I mean, you started correctly by saying that there's a huge gap, and that gap is not closing. Actually, I think what we're seeing now, if anything, is going to exacerbate that gap, which is the current interest rate position. So we're now in a position where, you know, the risk-free rate, you can argue whether the US is risk-free or not with the debt ceiling, but the risk-free rate is, you know, let's say 5%. That makes valuations of emerging market assets that much more difficult. It makes the relative return equation versus the risk equation that much more difficult. So I think, you know, we've talked in the past about the need for blended finance, the need for multilaterals to come in and support. That need is a multiple of what it was in a low interest rate environment. And I think that need for support and blended finance and people like Thierry to come in is greater than it's ever been.
But this is sort of a very bleak picture. We talked about it already in the past, and there was already this gap that was already significant, and now you're saying that actually it's, you know, it's going to get bigger due to these aspects.
I think it's. We said we were going to smile on our panel, not look bleak. So we're not going to be depressed.
Well, it depends on your sense of humor. You know, that's what you've got to keep.
I think, yeah, we know there's a wall of capital. There's still significant liquidity. We know that there are investors looking for assets to find. We know that there is a real need. What we need to do is accelerate the bureaucracy that comes behind getting these assets ready to bank.
Okay.
Smiling still as well.
No, I think first of all, the gap is increasing regardless of the market, because every year we lose, it increases in terms of requirement for investment because of climate. And so we're sort of chasing a running ball. And that's quite important to remember, because the more you do nothing about climate, the more it will cost you to fix it. I'm oversimplifying, but and so infrastructure has a big role to play in that. And I do agree that there is a lot of capital, but the allocation of capital to emerging markets nowadays is made difficult because the total risk premium perceived for these emerging markets is much higher. Compared to, so the risk-reward equation is a lot more complicated to sort of fit in. And I think a lot of us, actually in different capacity, we meet in the same places, talking about the need for blended finance to de-risk, to at least bring down this perception, the guarantee schemes, the subsidy scheme, concessional, you name it, to really mobilize. And I think there is one major shift which is positive, yet to be seen if it becomes real, is the awareness of a number of governments and multilateral agencies and institutions that they are the ones who can really mobilize and leverage the private sector and real capital allocation towards emerging markets.
And in terms of keeping the mood optimistic, you know, we've seen some really good examples of where that works. You know, we've seen, you know, we did some work for Saudi Electric looking at the linkage for electricity between Saudi Arabia and Egypt. You know, great support from actually Swedish ECAs in that perspective. We looked at some work in Angola at solar power, you know, a 2 billion project, I think 1.2, 1.3 was again ECA backed. In this case, it was Euler Hermes. It was German ECAs because there were a lot of German SMEs participating in the projects. So when they come together and work, there's a real delta, a real opportunity that to Thierry's point, actually starts to lift and improve the position in terms of ultimately power and sustainability as well.
Right.
So it can be done. We just need more of it and quicker.
And my positive example would be now that we even see solutions for adaptation, which is even more complicated than the normal sort of economic infrastructure. I mean, we've managed to create a fund to really address adaptation, but this was only possible because we had a number of DFIs, philanthropy, so the Rockefeller Foundation, the EIB, the DFC from the US, really supporting it to allow private investors to come and invest. And one of the very first adaptation projects that we just closed was in Mauritania to actually rebuild the coastal line, because they're really suffering this city from coastal erosion and allowing them to actually redevelop the new protected land from out there, which is long-term, very difficult to crack in terms of financial perspective, but yet, so you have investors looking at even financing adaptation today.
Right, and it also has a lot to do with this increased awareness as well when it comes to the projects like this. Thierry, let's talk a little bit about the difficulty of reconciling reindustrialization. This is sounds a very complicated aspect, and it is indeed, but how the infrastructure contributes to this. Some of the latest numbers, this is the McKinsey, but 80% of the private infrastructure investment in middle and low income countries has been in non-renewable energy and transport sectors.
Perhaps because they were essential, the transport sectors. I mean, industry generally needs quite a number of things. Some of them, I mean, energy being one.
Sure.
And so reindustrializing is, from the infrastructure perspective, is allowing industry to have predictable, affordable, clean energy, one way or another, whether it's electricity or something else, or predictable and clean supply. If you think about fertilizers, for example, where now they're looking at ammonium made of green hydrogen. The other thing that they do essentially need is logistics and the ability to move goods and services and people. And that's where infrastructure comes in, and that's where infrastructure also needs to be the sort of decarbonized infrastructure, because a lot of the scope 2 and 3 for this industry will be through this sort of infrastructure being cleaner. We were talking this morning about airport. If you don't have an airport that has a 0 scope 1 and 2 by 2030, I think it's going to be difficult to be sort of keeping your game in the market. Scope 3 with the SAF, it's coming, but it's a longer road. So infrastructure can play a major role in reindustrializing, however, by being also sort of targeting a net zero.
I think it goes beyond the industrialization as well.
Yeah.
I mean, if you look at the sort of new economy, look at the advancement in AI, I mean, the data consumption that's going to come from machine learning, AI is huge. The need, therefore, for data providers, data storage, to have power that is renewable. You know, the whole circle of where those companies locate, where the power locates, how you make that, you know, a renewably supplied energy, I think is really interesting.
But it's also about the pace and the scale of it and how to catch up on all of those. When it comes to, we already have, you know, with the AI, and as you said, with this, that's already like going in there faster, but that's not the situation in terms of everybody catching up on this.
I think if you, so I was in the US last week and talking to the big, you know, data warehouse providers, you know, the data storage guys, they've all got it high on their list of what they need to do. And I think, you know, the advantage is there's so much liquidity flowing into the space. Add that to the need, I think you end up with actually acceleration in the projects and the supply of energy around that. And none of them want to be producing their own electricity. They want people to do it for them. So it has almost the opposite dynamic.
Right.
No, I mean, I do agree that the data is essential. Even when you think about industrial processes, I mean, nowadays you have companies that actually capture data from your process to optimize it, to lower the consumption of energy, to decarbonize, and you do need to store all this to manage all this. It's really a big data issue, actually, and so it's fundamental for the industry as well.
Surely is. Simon, I want to focus a little bit more on something that you've touched upon. When it comes to the ability of many governments to incentivize the private sector, they're a bit constrained by these fiscal pressures. Let's talk about the traditional incentives and some of the unconventional ones as well that could be used. When it comes to unconventional, one of them that I would bring here would be lend.
So I think the first thing to think about is, where is the problem? And it's not just in emerging market as a blanket problem. This problem is most acute in a small number of low-income emerging markets. By definition, those governments don't have huge financial resources. Arguably, those financial resources have been depleted as a result of COVID and other investments they've had to make. So what does that mean? Be more creative. That land is one. But actually, I think you've got to stand back from that and look at where has there been success in the past. Success in the past has been where geographic barriers have effectively been eroded by support from multilaterals and other agencies. So I don't believe that just thinking about developing market governments on their own is going to be enough to solve the problem. I come back to from my perspective, that we need the multilaterals to think about, how do you look at long-term hedging of currency? There's big currency risk in some of these markets. How do you look at the capital cost that hits financiers? Project finance is a phenomenally attractive asset, other than the regulatory treatment of it on your balance sheet. Default rate is very low. It's predictive returns. It should be a really good asset for banks to invest in and support, but it becomes more and more difficult because of the regulatory environment. So when you add multilaterals, regulatory reform, maybe some of the more creative stuff around land, but I think there's a fundamental role that the developed markets have to play to support this. You can't push it all back to the emerging markets.
Thierry, what's your comment on that, on this?
I mean, a lot of it can be done in the conventional way to start with, and that's true both for emerging market and OECD markets or others, because if you just think about government having a clear strategy, a clear regulatory framework, and sort of straighten up and fly right type of attitude, that would solve 60% of the problem, right, in terms of being attractive, in terms of, and that's true even within the EU. So let's not just point fingers to the emerging markets. And so changing regulations and strategy in terms of delivery is one of the worst things for attracting capital. When it comes to, I tend to agree with you, it's the de-risking issue, and it goes in many ways. Is the perception is high, perhaps higher than the risk, but the risk is real. There is a real bad treatment, and I think of asset owners, asset owners who invest in emerging markets. As long as it's not OECD and it's not investment grade, your capital charge, if you're an insurer, if you're a pension fund, is a whole different story. And just having this sort of asset class of emerging market infrastructure being on the sideline of the regulation is an impediment. So they can only do so much of it. So you can say, I want to mobilize trillion, but if you don't find the ways to make them look like those over trillions in developed market, it's never going to happen. So there is a little bit of back and forth there in the discussions within the countries. But that regulation issue seems to be one that nobody really wants to tackle.
Yeah, that's not the first time we're talking about this issue, isn't it? And not the last one probably either.
But Thierry's right. I mean, transparency you can fix yourself.
Yeah.
And that
can be more
that's
conventional
on everybody
than that,
to do that. But then it comes around to many prods in many levels, I think.
Right.
And for such as this.
We are going to take now a few questions. If you want to ask a question, you've got to raise your hand. The only thing I'm going to ask you, please do keep your questions on the topic of what's being discussed here. I know it's rather tempting to ask the speakers about everything else, and there's indeed lots of issues that they could comment on, but let's keep it within our fireside chat topic. And just raise your hand if you want to ask a question and introduce yourself while you do. So, any questions from the audience? Oh, none.
Oh, there's one there.
Oh, sorry, excuse me. There we go. Can we have the microphone here, please? In the middle. Yeah, it's right here. Like, we're going to look for the mic. It's going to be in the middle, right next to the cameras. Please. Yeah.
Hello, my name is Sheriff Jean-Hugues. I work at Aegis Conseil. So it's an advisory firm, part of Aegis Group.
Could you keep the microphone? Yeah.
Yes. So my question is, in a market where you have very high rates, how can you actually, what kind of mechanism can you put in place to actually develop and accelerate the development of infrastructure in the emerging markets?
Thank you.
I mean, the rate increase is basically increasing the cost of capital, but it's not the only impact. We talk about the other one, which is actually worse. But the cost of capital issue can be solved by, blended finance and public finance actually targeting this affordability issue. Because what it creates is it makes those projects not affordable for governments, for users, if they're paying for it, and clearly this is where targeted concessional or subsidy can reduce the cost of it. I mean, I have a clear example in mind when I think about the Dakar BRT that we are building as an electric bus rapid transit, but this was only possible to come out of fuel with a number of subsidies from the EU, from a number of bilateral agencies. So you may not be able to solve it all, but if you actually target this public finance to sort out this affordability issue, you can manage.
Yeah, I think it's as Thierry said, it's subsidies. It's looking more creatively at things like first loss, so you can get greater return on that support you're giving. It's looking at export credit support and bringing in other nations. And then it's looking at the balance sheet impact of those people you want to invest. So it's tax and capital treatment. If you can address those four, or even some of those four, you can make a huge difference.
Thank you. Do we have Ola? We do. Yeah, that was a bit of French from me. Sorry, I didn't expect that coming from me either. I know, but I'm trying to, we're still in Paris. We're going to take one from there. Yes, thank you. I wish we could have more. That's going to be brief. One question, please.
Yeah, Thierry, a question for you. You've talked before about the fast infra platform. Would that be a way to resolve the gentleman's question and Simon's issues?
I mean, indeed, the fast infra platform, quick advertisement page, is actually, it's a market-led initiative joined by government, really trying to target and create a label to define quality infrastructure, and particularly useful for emerging markets to actually mobilize a lot of capital. But and this is, to me, a first step in terms of making it clear what is investable and of good quality and sustainable infrastructure for investors. But the perfect round will be when the good fast infra label actually gets you capital charge release or some sort of different treatment when it comes to your own capital structure. So it's, I think, a promising beginning in terms of identifying and focusing people, and also scaling, because one of the issues we have in emerging markets is every project is a new project, and so we need to scale. I won't use the word standardized because it usually irritates everyone. But it's scaling with labeling, if I could put it that way.
Right. Simon, very briefly, that was a bit of a moment for Thierry. Let me ask you very briefly, if you were to convince some of the private investors who are sitting here in the room to go and invest in infrastructure in your markets, what would you say that in 30 seconds?
I think the need is there. Actually, the opportunity is real. Actually, Thierry made a really interesting point. The perceived risk versus the real risk is often not the same. So, use a bit of a plug. Use somebody who's got some significant presence on the ground to understand those markets and form a proper risk assessment. Because I think the returns can be there, even with the rate environment.
Thank you so much. Thank you so much, Thierry Deau and Simon Cooper. Gentlemen, many thanks. And we catch up next year and we discuss whether that worked as well. Thank you. Thank you very much. Thank you. Apologies that we couldn't take more questions. This is always, when I first ask whether there are any questions in the audience, not many hands first visible, but then there are more and more coming. Unfortunately, the time is short and we have to be disciplined indeed, as the other moderators said. Now, you can always catch up with us on social media if you're using the hashtag ParisInfoWeek, and you can go into the networking platform as well. We are going to continue as the stage is being set up for the next fireside chat, and I'm inviting here on stage the speakers, Vincent Levita and Patrick Todivi. Please, the stage is yours for the next fireside chat.